Sampath Reddy, CIO of Bajaj Allianz Life Insurance, is joining us now from Pune. Sampath, good afternoon. Thanks so much for your time. What are you making of this mid-cap melting away, small caps? Do you think this will make the market healthy? What's your observation? Because large cap is quite okay, near about fresh highs.
Right. Right. Mid caps especially have moved up a lot in the last few months. I think there's a small amount of correction taking place. But if you recall, overall, this entire rally in the markets, if you see, it was pretty much, I think, driven by the Fed and, fiscal stimulus by the various governments. That is what has actually kept the market moving up in such a rapid way. And similarly, I think now if we were to look for big correction in the markets, I think again it will be driven by the the Fed and liquidity and the fiscal stimulus. These are the things which will really one has to be watchful for. And if you go back and see historically, in the whether it's in the 2000 during the technology bubble or during the 2007-8 pre-Lehman era, whenever if it was to be induced, if the correction were to be induced by the taking away the liquidity back by the Fed, it is, we have quite a long time to go in my sense. In 2000, probably I think after hiking the rates by about 6-7 times, that's when really the market started correcting. And it was same thing in the 2007-8 also. Even after, raising the rates, about 5-6 times, I think get to up to 4.5%, that's when the really market started correcting. Now we are talking about just, the tapering, talks of tapering in somewhere in October, November, December, and in probably the first rate hike in 6-7 months away or even more than that. So we have a long way to go in terms of if it were to be if the correction were to be again the Fed induced or liquidity tightening. From that perspective, I think we have a long way to go. I think this is a small correction, is what my sense is. This is what it looks to me. Having said that, yes, the valuations have been on the higher side, but that's how it has been, even during those even those two instances of market peaks driven by the liquidity. So in that sense, I think we have some time to go for the market correction. Yeah, mid caps, especially in the last few months, have rallied a lot. I think there is a correction taking place. I think it's a good opportunity to enter, is what my.
Right. Sampath, if someone who's a portfolio investor who looks at bets on a 3 to 5 year basis, in 3 years from now, even if, because tapering, whenever they start, it will not be full on, it will be a very gradual phase down. And market may actually start pricing all of that in ahead. If someone is taking a 3 year view, do you see an average portfolio from current levels in positive territory in 3 years from now? Or do you think it could be challenged, returns could be challenged even in a 3 year window?
I think, see, even in a very bearish market, even in a market where there is substantial correction, always there are a few stocks will always perform it will do better. Now, what is driving this rally in the past 2-3 years, may not be the same ones will drive for the next 2-3 years. It is very much possible that some of these very well performed stocks or sectors may take a breather, and some of the ones which have been laggards may come into the into the rally. So that as a well constructed portfolio, perform along with some value stocks, along with some cyclical stocks, and some defensive bets taking together, I think from a 3 to 5 year perspective, one could construct a good portfolio which will give decent positive returns from now.
Sure. Let's understand your thoughts on two areas. One which has done phenomenally well and surprised many, and not many could catch the full rally. I'm talking about steel and metals. And the other one which people by and large have shunned because of COVID impact. I'm talking about financials, especially private sector banks and few large NBFCs. Barring, say, a Bajaj Finance, or some of them have outperformed, but barring those, financials have been, kind of been a laggard last 1 year. Do you think, what are your thoughts on these two areas?
Right. See, let's look at metals first. Most of the aluminum and steel and all of the commodity prices have moved up quite substantially in the last 6 months. And based on the current prices, the free cash flows to the most of these commodity companies is exceptionally high. I mean, from here on, if steel prices or aluminum prices need not go up further for the metal stocks to give a good positive returns. Even if the steel and aluminum prices were to remain here for the, let's say, 3 quarters more, they will, I mean, I would still think that these commodity stocks can give a very good return from current level, because at these prices, almost about 25 to 35% kind of a percent of the market cap is being generated every year as a free cash by these companies. If the price were to just remain where it is, you would still easily can make upwards of 10 to 20% kind of returns. That's how the commodity prices are today. I think some of it is driven by the Chinese side of it. Chinese government curbing the excess production because of the pollution-related issues is also helping the overall market. And even if you look at today, for example, the steel prices in the US and Europe is substantially higher than what it is there today. Almost I think $400-500 higher prices are there in per ton in these developed markets. And not only that, most of the the global headlines, if you look at in terms of where spending is going to be, the US market, US seems to be spending, going to spend in a significant way in the infrastructure side. The bill is at the Senate level and all that. So if that were to happen, I think, the demand for the commodities led by the infrastructure spending by the developed countries continue to be there. All we need to do is that, the steel prices or aluminum prices should stay here for some more time, maybe 2-3 quarters more, so that the prices will continue to go up. That's why we still like this sector at this juncture. And in the, the banks, I think among all other sectors, probably the banks is somewhat, I think, valuations wise, they are somewhat close to their, historical mean, whereas most other sectors, if you look at it, they are higher than the historical, mean, substantially higher than the historical mean. It's just that, the last quarter, there has been slightly higher slippages than the anticipated levels, because of which I think the banking sector has been not performing so well for the last 3 to 4 months. But we still like the top 4-5 private sector banks. They are very well positioned. Their capital adequacy is exceptionally good. They have very strong management team. Most of them is fully embracing the technology. I think they will. There's a lot of opportunity in the top top private banks is what I would think so.
Right. Before I let you go, Sampath, I want to understand across mid and small or even large cap, which is the area of the market in your view, which in the new environment where marginal risk off is also started coming on the table, offers the best margin of safety in your view?
I think, given the way the mid caps have risen in the last few months, at this juncture, we believe that large caps are slightly better positioned from a risk reward point of view. Most of the the large private banks we talked about, even the commodities are also pretty much large companies. At these level of markets, I would bet more on the the larger cap segment than the mid cap, because market is not where it's close to historical mean valuation. It's slightly much higher than the historical mean valuation. It's very much possible that corrections could happen anytime soon. So in that backdrop, I think the better risk reward is there more in the larger cap sector.
Right. All right, Sampath, we'll let you go on that one. Thanks so much
Thank you
for
for
joining us on the show today.